welcome to the deep dive. You've sent us some really thought-provoking material this week, all zeroing in on that universal feeling, the tightening in your chest when you think about losing money.
Yeah, that gut reaction. It's powerful.
Totally. So for this session, our goal is to really dig into why that fear is so powerful and how it shapes the financial decisions you and, well, all of us make. The sources you shared explore everything from our most basic survival instincts to some fascinating ideas in behavioral economics, plus some practical strategies for actually taking the reins on that fear.
That's a good mix.
Think of this as getting a clearer lens on your own financial behavior, kind of a shortcut to making smarter choices without getting, swept away by emotion.
Indeed. What really stands out across the sources is the emphasis on how this fear isn't just a logical response to potential hardship. It's woven deep into our being, influencing us in ways we might not even realize.
Okay, let's unpack this from the beginning then. The material suggests this isn't some modern anxiety fueled just by, market tickers and 247 news alerts. This fear of financial loss has much deeper roots, right? Goes way back.
That's exactly right. If we think about the vast sweep of human history, our brains developed in an environment where resources were often scarce. Super scarce.
Right. Life or death stuff.
Exactly. Losing access to food, shelter, essential tools, it wasn't just inconvenient. It could literally be fatal. So that fundamental drive to protect what we have, to avoid depletion at all costs, it's a legacy of that evolutionary past, a very primal alarm system.
So that nervous feeling you might get when your investments take a little dip, that's basically the same biological wiring that warned our ancestors about, a dwindling berry supply or something.
Pretty much. It's a powerful, deeply ingrained reaction, even if the modern financial landscape presents, very different kinds of threats.
It's wild how that ancient wiring plays out now.
What's fascinating is how it plays out in our contemporary financial lives, even when the stakes, like you said, aren't about immediate survival anymore. The emotional response can still be incredibly intense, even if the actual consequences are, less dire. And this is where behavioral economics offers some really valuable insights.
Okay, and that brings us squarely to loss aversion. That's a core concept here, isn't it? This is Kahneman and Tversky's big idea from prospect theory.
Absolutely central.
The principle that the negative feeling of losing something just outweighs the positive feeling of gaining something of equal value.
Precisely. And the research consistently shows this asymmetry. The psychological pain of a loss is significantly greater. Often people say around twice as strong as the pleasure you get from an equivalent gain.
Wow, twice as strong.
Yeah. Picture this. Finding $20 on the street might give you a nice little boost,
Yeah,
right?
great.
But losing $20 that was already in your pocket, that likely evokes a much stronger, more negative feeling. It just lingers longer. That imbalance is really the crux of loss aversion.
It's like the bad stuff just sticks more. You might forget a small win pretty quickly, but a loss, even a minor one,
Yeah,
it can kind of cast a shadow.
Yeah.
So how does this fundamental tendency influence the financial choices people make, according to these sources?
Well, one of the biggest effects is definitely on investment behavior. Loss aversion can make us extremely risk averse. Way too cautious sometimes.
Okay.
We might shy away from investments that offer real potential for substantial growth simply because they also carry the possibility of decline. Our focus gets so fixed on avoiding any potential downside.
That you miss out on the upside.
Exactly. You inadvertently miss opportunities for significant long-term gains.
It's like being so scared of stumbling that you never even think about taking a step forward.
Yeah.
And the sources also highlight panic selling during market downturns.
Yes.
That's a prime example of loss aversion kicking in, right?
Oh, absolutely. Classic example. When the market takes a hit, that fear of seeing your investment value erode further can become overwhelming. Loss aversion just slams down. The emotional distress of seeing your portfolio shrink becomes so acute, so painful, that you feel this powerful urge to sell, often at precisely the worst moment.
Locking in those losses.
Exactly. You solidify those paper losses into real ones. It's an emotionally driven decision that can completely derail even a well-thought-out investment strategy.
Okay, so we have this deep-seated aversion to loss, this tendency for bad financial stuff to hit harder emotionally. But the sources also talk about how other quirks in how our brains work, these cognitive biases, can actually amplify this fear. Could you elaborate on those?
Certainly, our brains are constantly trying to make sense of a really complex world, right? And to do that efficiently, they rely on mental shortcuts, which we call cognitive biases.
Right, the shortcuts.
Yeah. And while these shortcuts can be useful sometimes, they can also lead to systematic errors in our thinking, especially when it comes to money and our fear of losing it.
Let's revisit loss aversion itself then. The sources bring it up again in the context of these biases, but with a slightly different angle.
Yeah, so in this context, loss aversion as a bias refers more to how just the anticipation of a loss can disproportionately sway our choices.
Ah, okay. Not just the feeling after the loss,
Yeah.
but the fear before.
Exactly. Even the mere possibility of a financial setback can loom really large in our minds, often overshadowing the potential for an equal or even greater gain. It just skews our perspective, makes us inherently more cautious, less willing to take calculated risks.
It makes sense. The thought alone can freeze you or push you towards safer feeling options, even if they aren't actually the best long term. Now, what about this status quo bias? That sounds like just sticking with what you know.
Precisely. It's our powerful preference for things to just stay as they are. Change feels risky.
Mm-hmm.
In finance, this often means sticking with our current investments or bank accounts, even when much better alternatives might exist. The perceived risk and, frankly, the effort involved in making a change.
Yeah, the hassle factor.
Right. Plus the fear of potential losses from that change, or just the discomfort of the unknown, it often outweighs the potential benefits of switching.
So you might be holding on to, like, a savings account earning practically nothing just because it's familiar,
Yeah.
even though other investments could offer way higher returns over time. The fear of making a wrong move keeps you stuck with what you know, even if what you know isn't really working for you.
That's a perfect description. And then there's a bias that might seem a bit counterintuitive here: overconfidence. How does thinking you're better than you are connect to the fear of loss?
Yeah, that seems odd. You'd think confidence would fight fear, right?
Well, the sources point out something subtle. Overconfidence can lead us to underestimate the real possibility of losing money. We might think we're smarter than the market or better at picking stocks.
The classic I know what I'm doing syndrome.
Exactly. But when reality inevitably bites back and losses do happen, because they always do, eventually the impact feels way worse because it shatters that confidence. It amplifies the fear, then can trigger even more drastic emotional reactions next time.
Oh, I see. So you take on too much risk because you think you're invincible. Then when you inevitably get hit, the shock is bigger, making you even more scared of future risks. Kind of a self-inflicted fear cycle.
Precisely. And it's so important to remember that these biases rarely work alone. They often interact, reinforce each other, creating this powerful psychological headwind that can stop us from making rational, wealth-building decisions.
Okay, this is painting a much clearer picture of why this fear is so ingrained and the mental machinery behind it. Let's shift gears a bit to the practical side. How does this fear actually look in real-world investment choices based on the sources?
Well, as the sources illustrate, it shows up in several key ways. One really common one is just avoiding anything seen as risky.
Like stocks, maybe.
Often, yeah. Asset classes like stocks, which historically have offered higher growth, but also fluctuate more in the short term. The fear of seeing those temporary dips can keep people completely on the sidelines, even if the long-term outlook is really strong.
So people might pile into what feel like safer havens, like low-yield bonds or just holding tons of cash.
Yeah.
Even though inflation is quietly eating away at the value of that money over time, the perceived safety of avoiding any nominal loss outweighs the opportunity cost of missing potential growth.
Exactly right. Another big one, as we touched on, is overreacting to market volatility. When the market drops, that fear of further declines becomes overwhelming, panic selling.
Right, the sell low trap.
Yeah. Investors who, in calmer times, might stick to their long-term plan suddenly just liquidate everything at depressed prices. They turn a paper loss into a permanent real loss.
Driven purely by that fear of seeing the numbers go down even more. And the sources also mentioned sticking with super conservative, low-yield options. This really boils down to that core desire for capital preservation above everything else, doesn't it?
Yes. The main goal becomes just avoiding any possibility of losing the initial investment amount, even if it means getting returns that barely keep up with inflation or maybe even fall behind it.
Which isn't really preserving your purchasing power.
Not at all. And while protecting capital is important, of course, being excessively risk-averse can seriously limit your ability to build wealth over the long haul and actually reach your financial goals.
Okay, so recognizing these patterns in ourselves is step one. But what tangible things can we actually do to navigate this fear? The sources you shared offer some really practical strategies. Let's get into those actionable takeaways.
Absolutely. The good news is, while this fear is fundamental, it's not, insurmountable. Education is a really powerful tool here.
Just understanding things better.
Yeah. Getting a solid grasp of how financial markets actually work, looking at historical trends, learning about the nature of investment risk, it can make those short-term swings seem less random and therefore less scary.
It's like shining a light into the dark corners, right?
Yeah.
The more you know, the less power those fluctuations have to trigger that anxiety. What's another key strategy? Diversification comes up a lot.
Oh, absolutely crucial. Spreading your investments across different asset classes, stocks, bonds, real estate, maybe different industries, different parts of the world.
Don't put all your eggs in one basket.
It's the fundamental risk management principle. If one specific investment tanks, the hit to your overall portfolio is much smaller. That really helps mitigate the fear tied to any single loss.
That makes perfect sense. Building a kind of financial safety net. And the sources also stress having a long-term perspective on your goals.
Yes, setting clear, well-defined financial goals that stretch years, even decades, into the future really helps reframe your focus.
Takes the spotlight off the daily noise.
Exactly. Instead of getting obsessed with the inevitable short-term market ups and downs, you stay anchored to your bigger objectives. That longer time horizon makes temporary dips feel less like catastrophes and more like just bumps on the road to your goals.
Seeing the whole journey, not just the immediate pothole. The sources also mention mindfulness and emotional regulation techniques. That sounds like a skill useful way beyond just finance.
It certainly is. Practices like mindfulness meditation can help you become more aware of your emotional reactions to financial news or market moves without getting totally swept away by them. By cultivating better emotional control, you can approach decision-making from a more rational, less reactive place, especially during volatile times, instead of just acting out of fear.
So creating a bit of space between the trigger, like seeing your balance drop, and your immediate reaction, letting you choose a more reasoned response. And finally, seeking professional guidance is suggested.
Yeah, for many people, working with a qualified financial advisor can be a huge help. They offer objective advice, help build a plan suited to your goals and risk tolerance, and provide crucial support during tough market times.
Like an emotional buffer sometimes.
Kind of, yeah. And similarly, if the fear is really deep-seated or causing significant distress, talking to a therapist specializing in financial behaviors can provide valuable tools for managing those intense emotions.
It's about recognizing when you need some extra support to handle these powerful emotional currents. So pulling it all together, it seems clear that fearing loss isn't a weakness, it's just fundamentally human, shaped by our biology and our psychology.
Exactly. And the core message from all this, I think, is that just recognizing these mechanisms is the crucial first step towards taking control.
Awareness is key.
Once you understand why you might feel that fear and how it might be subtly steering your decisions, you can proactively start using strategies to manage it better.
Right. Moving from being unconsciously driven by that primal fear to making more deliberate, informed choices that actually align with your long-term goals.
Yeah.
Finding that balance between natural caution and, necessary opportunity.
Precisely. That's the goal.
So for you, our listener, as you think about this deep dive, maybe take a moment. Consider which of these biases might be playing the biggest role in your own financial thinking.
Mm-hmm. Good exercise.
And maybe identify just one small, concrete step you could take. Perhaps it's reading a bit about market history, looking into diversification, or even just taking a few deep breaths before you check your accounts next time. It's all about starting to build a more conscious, more empowered relationship with your money.